afternoon. I hope everybody's well and you're having a good day so far. Some of you may know me. I don't know, but I've been around real estate for several years, and actually since the beginning of my public accounting background. So I've been invited a few times onto these webinars just to share a little bit about uh, real estate or just about taxes. And so I appreciate the invite and glad to be here. Um, Today we're going to talk about basically some areas around investing and just around specifically around the real estate area, but talk generally about how that looks on a person's return, and maybe just some maybe bring some information to the table for you that you may not already know or maybe have questions about. And a lot of times people have a lot of questions related to real estate professional, just what that means, how they can get there, what would that do for them if they were able to uh, uh, you know apply the election to their return. So we're going to cover those areas today. We're not going to be real in depth on it, but we're going to at least give you some information that you can take away from this and hopefully apply it to your personal situation. And obviously the things that we discussed today, it's important to talk to your own tax professional about and let them be the ones to kind of converse more with you. So first I'm going to just kind of describe what that looks like for people who may be investing in real estate specifically. There's two ways that people are represented in this particular area. And as you know it, this is something of that can widely spread across different areas of real estate. This could be in commercial rental, it could be in multifamily, it could be in single family. Typically, every person that's involved in real estate is going to be first qualified as passive. And that just means that you're not materially participating in the day-to-day activities. So you're not, making operational decisions, or, if you're in a area of whether to obtain a loan or not obtain a loan, or, or to hire this person, not hire this person. So if you're not in that kind of realm day to day, then typically they can, IRS would say that you're a passive investor. And when you're passively investing in something, a lot of people know this to be true, that, hey, there's not a whole lot of responsibility in my category. I'm not really, doing anything other than writing that check and giving it to the person that's going to take that investment and hopefully make that grow for you. And so when you're writing that check and giving it to them, really that's the only risk that you have in it is the check that you wrote. So you're not necessarily needing to sign contracts or sign loans, or be more obligated to that operation. And so a lot of times people really love that realm because they can go about their daily business and let someone else kind of help grow that money as they're in their working environment, and not have a whole lot of exposure to their risk other than the amount of money they wrote. Now, when you're looking at it as an active investor, there are some things that bring more activity, which requires you to be more involved, right, in that realm. And a lot of times what we're talking about when we're saying active in this particular setting is that you're materially participating, okay? Which means that in your case, you're going to be doing the opposite. You're going to be working in that day-to-day activities to some level, making decisions, signing contracts, signing on mortgage loans. You also kind of held out and expected to do performances, and those performances are helping that property or asset improve and grow and improve on the growth that people have expected you to do, right? You also may even oversee those regulatory requirements and legal requirements that you have. And so in this particular setting, we're talking about those are the passive and those that are active. But we're going to hone a little bit more in on the active side and what that looks like for those that may want to consider being more and more involved in that particular setting, and may even see what that means to them when they're more involved, and how does that impact them? What does that look like for them tax wise? When we're talking about material participation, I'm just going to bring a few things to the table just so you understand what that means, so that when you're trying to apply this to your personal situation, um, what are the things that you're currently doing that might fall under this area to give you that active status. The first thing that we're going to talk about is a regular and continuous activity. And that really just means that you are pretty much on a weekly basis participating in that activity. And that activity that we're going to be discussing it covers a lot of different areas of where that activity can fall. But for this particular discussion, we're going to be talking about how active are you, and how regular is that? And is that something you're going to do all year round, or is that something you do maybe occasionally? What IRS would like to see on this particular status is that you're doing something on a regular basis, meaning that every week, in this particular case, we're talking about 750 hours. Every week you're putting in at least 15 hours a week, and you're consistently doing that throughout the year. And the requirement for this participation can come from not just you, but if you're married and you're filing a joint return, your spouse may be doing some time, you may be doing some time, and together that time is exceeding that 750-hour requirement. So in other words, if one spouse is more active in the real estate, wants to materially participate in that real estate area, and they want to become more, more of the real estate professional realm, then they can use the hours that the spouse has put in. So maybe they haven't met the 750 hours themselves. Maybe they're only able to do 400 or maybe only 500 hours of that time, but their spouse's activity that's being applied also to that same area can then be added to their time to meet that 750-hour requirement. So these activities that I cover is really maybe very broad, right? Because there are several different areas you can participate in, and this is going to cover a lot of different people. Maybe you're a realtor and you're selling homes, or maybe you're a developer and you're building real estate property. Maybe you're buying and selling real estate properties, and that's what you do for a living. Maybe you're leasing, and you may be leasing directly, or maybe you're using a property management group and then to lease the property. Maybe you're actually managing that group of assets, or maybe you're managing a selective few that bring about that number of hours that you need. You can actually cross over, and such as have some management hours and then also have some leasing hours, or also kind of have some development and management hours. So you can mix and match this particular area. There's no requirement that you have to have 750 hours and in one particular activity. What you're really looking for in this is that you're participating in the allowed list of real estate activities in total to get that 750-hour requirement. Okay, so I have a client that he's both a management company and also a broker. Okay, so the brokerage in this particular list is qualifying when you are part of that middleman where you're closing a deal, right? So you're for him, he's like handling the titling of it, and he's processing the closing, and facilitating the actual deal. If you were a lender, for instance, and you're a mortgage lending, or facilitating anything on the finance area. I just want to bring that to your attention. That doesn't qualify in this particular case. Unfortunately, a couple of years ago, several years, I guess now, intentionally they left off the financing part of this qualified real estate activities. So unfortunately, if all of your time is spent in the financial realm and you can't get the 750 in any other realm of a real estate activities, you may find yourself losing out on this particular status. Okay, so as long as you're qualifying in such as the the standard list, and if you have questions, I mean, obviously these are really broad, right? So this could be more specifically to you in your situation. And again, I would say have those conversations with your tax professional to say, this is what I'm actually doing. Where does that fall in the real estate activities? Some of the people may find that their day job, their W-2 day job, is actually in real estate, okay? And they're doing things in the real estate area. You need to be specific when talking to a tax professional. Then what is that you're doing in your day-to-day job that may actually help boost you into this activities realm, along with the outside hours that you have, okay? And discussing that, because that can also lead complication at times, depending on what you're being compensated for in your W-2 service, but it doesn't exclude you from the hours. So what happens if you're a real estate professional and you say, okay, hey, I've met my 750 hours. I'm able to get there on that. I know I am active on these particular activity levels. What does that mean to me then if I were to go there? Other than we know there's, some more responsibility of my time, and, the possibility I might be signing off on contracts or loans. What else is there though that would be an advantage to me if I was to want to go in that direction? And so we're going to highlight a couple of these areas and just talk a little bit more about that specifically. And one is that, of course, it's more of an obvious one, right? That I'm not passive at this point. So what does that mean when I'm not passive? That just means I don't have any limitations now. When I'm looking at my tax return, I wouldn't have any more limitations on my tax returns to take any of these deductions I might be getting from my activities in real estate. So if you're looking at it in a passive investor viewpoint, the passive investor would say, I don't have all these responsibilities, so therefore I don't get those immediate deductions. Not that you're losing out, because make it clear, you're not losing out on a deduction because you're passive. It just means you have to wait for it. So when you're waiting, that just means, okay, well, I may not be necessarily saving a whole lot of money while I'm waiting. I get to save it at the end. But when you're talking about an active investor, we're actually getting to see now those real numbers coming through on the tax return, and it's affecting our tax liability. Okay, so one thing that we are able to do when we're on the real estate material participation level, we're able to take those K-1s that we would get because we're owner in a particular real estate. So let's use multifamily for an example. We're owner in a multifamily deal, and we're also active. Okay, so this may mean that we're a sponsor. Maybe you're an asset manager. Maybe you're an active KP. Okay, so you're then getting a K-1 because you own. A lot of these deals might say you're a sponsor, so therefore you're going to get a certain percentage of a Class B type ownership, which gives you right to a K-1. And that K-1 is then going to share some of the benefits from the multifamily property. And those benefits actually bring to you a loss on the K-1. Okay, so what happens then is you're receiving that K-1, and that loss is on a material participation level going to apply towards your W-2 or your wife's W-2. Your 1099s you might be getting, and those 1099s might be from like interest or dividends or maybe from stock gains. So you're able to realize the K-1 losses on your tax return and at an ordinary income tax rate. So if your ordinary income tax is at 24% or 32%, you're getting the pass-through at your ordinary income tax rate. And it's actually then a deduction against your income tax that year. You're also being able to realize bonus depreciations, which is what we're saying sometimes is a loss that you're receiving. Other times, the loss in your K1 just could be because maybe they have CapEx going on, or a significant amount of repairs, and maybe there's operational issues. So maybe their occupancy level is lower because they're, let's hypothetically had a client one time that he had like 2 buildings that he wasn't able to lease out because he was having to remodel. There was just a lot of problems there. So he wasn't able to rent those units out. So, therefore there's a drop in operations, and that's leading to losses on your K1. The bonus depreciation is something that we get in the first year that the property is purchased, and it can come in subsequent years when you have CapEx going on that are improvements that are qualifying under this bonus depreciation rule. And the bonus depreciation is right now under the current law, 100% of those costs in the first year are written off under depreciation. So we have this great benefit. A lot of people are really attracted to this, right? Because it's a tax benefit we're going to get against our income tax brackets. But you should know that those are a one-time hit, right? So when there are costs such as acquisition in the first year or any CapEx in any one year, that's when the bonus is going to be realized. Any other year after that, you will get depreciation write-offs against your operations. And those may be of a smaller scale. It just depends on the property and the size of the property. But that bonus depreciation ends up coming through. And in first year, as an active owner, and let's just say right now for our purposes, let's just say that you're an owner and you're sponsoring a deal, and you're actively involved in that. And because of that, they're going to give you units because of your service. This does mean that you're not putting in that capital call. Everybody else has a cash contribution into the company because of your service, and because you're signing on the contracts and personally guaranteeing the loan, that because you're doing that, you're going to get compensated for ownership on the B side with no cash in. When you're in that certain setting, now it depends on each deal and the operating agreement of each deal. But let's just say that this operating agreement says that you're entitled to that pass-through because of your risk, signing contracts, your performance risk, and signing off on the loans. You're entitled to your share of that K1 in the first year without capital infusion. Okay, so you're able to realize that bonus depreciation deduction again in the first year of that against your W-2 and 1099. Well, let's say that in that first year, your income is much lower than that actual bonus depreciation that you're entitled to. It comes through and it absorbs all the income that you have on your return, and there's still even leftover depreciation. As a material participator, what you're getting is a loss carry forward, and we would call it a net operating loss. So that operating loss then becomes something you're even going to benefit from in the future. And right now, what you know is under our current loss until 2020, so we have 2018, 2019, and 2020, as a result of our COVID, we're now getting a benefit of even being able to carry back those losses, 5 years back. So let's say that in 2020, you decide you are qualifying as a real estate professional and you do sponsor a few deals. Right now, I know the market's really slow. Hopefully this turns quickly. And of course, there's deals out there. We all know that there's deals out there. There's probably not as many as we would have seen in 2019, but we're still seeing that there are deals available. So let's say that you are a sponsor and you do choose to do a couple of these, and you feel like the activities you're doing do qualify you for a real estate professional. Then comes your 2020 return next year. If you have those losses that exceed your income, then you're able to take those losses and carry it back to as far back as 2015. And that, one particular client I had asked me, well, I wasn't doing that kind of activity in 2015. Do I still get to carry that back? And that's not, that particular carryback is not particular to the activities that you were doing in that year. It's just the law that allows you to go back 5 years. Okay. So at 5 years ago, you may have had higher income. Who knows? Right. And if that's, we also had a higher tax bracket, as we all know, because our tax reform for what we know now occurred in 2018, which lowered our tax rates. But 2015, we had a higher tax brackets. So what we could be benefiting from is then the additional money coming back to us from a lost year in 2020, now bringing us some cash from the 2015 year and possibly even 2016, depending on how large your loss is. Of course, any of that loss then does absorb over 5 years. So you begin with 2015 and carry it all the way to 2018, 19 until there is no more loss left. So in this particular setting, until 2020 is over with, I mean, this is definitely an opportunity that some may even be more interested in because of the COVID provisions that we have available to us. In addition to these pass-through benefits, we also have the ability to maybe take even advantage of our retirement benefits, but not be subject to the UBIT. So in some cases where we have now been a sponsor on a deal, maybe that deal says because of your sponsorship, you're also going to get a share of asset management fees. Okay, and this is kind of maybe one of the forms of the deals that I've seen come through where they will compensate those people that are signing on the mortgage and signing contracts and having the performance risk. They'll compensate them on a monthly basis or maybe quarterly basis with a share of the asset management fees from the property itself. So say you would get that compensation in, and you had some funds that you wanted to use from your retirement benefits. So maybe you wanted to do some more deals that you're not necessarily the sponsor on. Maybe you're just only a passive member on, but you want to be able to do those deals as well as be a sponsor. When you're looking at opportunities of cash and you have it set in your retirement account, you may be wanting to think about possibly using those retirement benefits towards a deal, and you're not able to use it because of the UBIT requirement. You don't want to pay the tax. You want to consider something other than that IRA. The opportunity to now do a solo 401k is brought to the table because of material participation and your ability to open that because you're getting compensated from asset management fees. So now you have an avenue of being able to grow some more wealth of opportunity here in your retirement benefits and not be income taxed by that. So in other words, if you were to use the SEP IRA, possibly then you would have the UBIT issue because of the investment. So there would be some tax that the IRA would have to pay along the way. But moving it into a solo 401k now eliminates the taxation and allows you then to have a better investment growth inside that 401k. Now, let's say that is a passive deal and you also have then your active deals going on. Because your material participation, it actually is putting this kind of umbrella of the activity that you have, your material participation, even over your passive investments. So now you have your sponsor roles and your passive investments kind of under the same umbrella of the real estate professional, allowing you to take the deductions that you're receiving from the passive investment along with the personal investment that you're making as a sponsor. So this is aside from the 401k. So if you have a 401k receiving those benefits, you need to clarify that those are not benefits you're receiving on your personal return. But if you were to do passive investments individually through cash investments, there then would be more benefits to you through your passive investment along with your sponsor role. So oftentimes what I see in a deal is that potentially the sponsor may also invest in the Part A. So they have the agreement says we are going to put the ownership in two separate units, one being the A unit where you would invest in it passively, and then B being the unit where you're investing in it through your sponsor role. And so you may then choose to invest in both the A and the B, and then therefore it does mean that you are putting some cash into the deal, but in return you're going to get the benefit of that bonus depreciation and the other benefits that may come through your K1 as you're holding it. So what does that look like then when you're talking about the income taxation between a passive and an active investor? And again, on the active, we're going to use the material participation clause, because what we're saying here is that you're not there is an activity description in the tax law, and I just want to be clear on that. That says you can be active, which means that all you're really doing is kind of collecting rents or something very, very light, which doesn't require any hours, but it also allows you to get up to $25,000 a year in a write-off. But that also is limited to some certain income items, which means that most people who earn $200,000 or more are not ever going to see that benefit until they sell it, which is what the passive investor would look like. So I'm not bringing that to the table today. What I'm bringing here to you is more of a material participation on the real estate professional aspect and that of the passive investor. So if for purposes of just easily comparing the two, okay, we have the same income sources coming through, but a description that I'll explain to you. The earned income approach under the passive is going to be something like the W-2, and they're earning something on their day job with their W-2. On the active comparison, we're going to have earned income coming from asset management fees, maybe acquisition fees, maybe sponsor fees. Okay, so that's the difference here on our earned income. So we're talking about somebody who is materially participating and not in their full-time work environment when we're comparing the active role. We're also going to assume that both of them are also earning monies in stock market, so they have their investments in other areas, and they're receiving some kind of income from that, and all of this being subject to the ordinary tax rate. And we're also then going to say you are investing in a multifamily deal, and you're getting a K1, and that K1 is giving you $65,000 loss, okay? And this could be we're going to just assume it might be a $100,000 investment in that property during the year, and we're just, every property is going to be different as to what that bonus depreciation is going to look like. Most often, what I have seen is that the bonus depreciation can be as much as 45%, but then also I've seen some be almost like 80% of your investment or more. So it really depends on how they're structuring that particular investment strategy with that property as to how much you're going to get, and also what the cost study is going to provide. So typically when you're talking about a bonus depreciation, we're going to see that in that first year purchase, they're going to seek out a third party, and that third party is going to perform a cost study on that property to help us identify what costs are eligible for the bonus depreciation. So in this particular study, we're going to say that $100,000 investment actually is yielding you $65,000, which is including your bonus in that first year. On the passive investor side, they're not losing out on that $65,000, but as I mentioned before, it's kind of on hold, and it's a wait and see kind of thing in the future. So it's subject to what we call our passive loss carry forward. But on an active investor, what we're seeing is that $65,000 is going to be readily available to offset the $200,000 and the $15,000 that they've received, and they're going to see now that write-off coming through on the return, not limited. And let's also say that in both scenarios, you're getting $12,000 a year in quarterly checks, okay? And this is just hypothetical numbers, and again, these are all different based on the deals that you have, what that number looks like. But you're getting those, what I would call mailbox money on the passive investor side, because you're not really working for it. You're just receiving it because of the way that the property is operating. Okay, and on the active investor side, they may be receiving those checks, but it isn't really indicative to their involvement necessarily that they're receiving it. They're getting that benefit because of their ownership in the equity, and which, if a passive investor is getting their share, the sponsor is also getting their share of the equity distributions. So we're saying this is in and above what you would also be compensated if you were working in that environment. okay, and you were a sponsor getting compensated acquisition fees or sponsor fees or asset management fees, whatever that would be for your risk that you're taking with that. Okay, so we're saying here that neither one of you are going to pay tax on that $12,000 because it's an equity ownership. In other words, what it's doing is giving you return on your capital or return on your investment. And so those particular checks or checks that you'll receive, not specific to the performance of the property sometimes, because there might just be that they're paying out that particular investment or distribution because there's cash reserves there, not because operations have been the greatest this year. So again, it's going to be dependent upon the property. So in a passive investor point of view, they're going to estimate their tax to be somewhere around $64,000 because, it is what it is. It's ordinary income based on their W-2 and their interest and dividends income, and they're not going to be able to benefit from the $65,000 in the current year. So they're going to pay what they would normally pay until at some point in time they come to the end of the period where there's a gain. That's when they're going to realize that $65,000 benefit. On the active investor, like we said, we're offsetting that against our earned income, against our interest income. So now we're going to pay only $40,000. So I'm doing this example in order to compare that you would save around $24,000 in an active role, right? So there is a significant savings that can come about. And all these numbers being said, I would say there's quite a few of my asset managers at times that may not pay any income tax because of the bonus depreciation and because of participation in multiple properties, and maybe even to the point that they have invested in a ownership as well. Okay, so because of that, they're receiving all of these particular benefits, and they're coming through in one particular year or offsetting one another so that it's benefiting them in the income tax realm, and they're able to save their dollars. In both settings, you are getting a benefit. I think that they're realized differently. It's a timing perspective on it, but there's benefits in both areas, and in some cases, some will see that the benefits of active investment may be even more advantageous to them, and they're willing to take a little more risk for it. Okay, and so this is really one thing that people should consider. I mean, the tax benefits are definitely there, and you have to be okay with the particular activities and things that you're needing to do on the sponsor role in order to to realize this benefit. Sometimes it is time demanding, and so we do see people completely leaving their job and going to the active investor role because of the demands that it has in this particular area, and it's hard to do two things at once. Again, when you're talking about whether you can meet that 750 or not, some people may on the passive side feel like they're meeting that 750 hours but not be able to qualify for the real estate professional activity because of their day job. And those particular situations and that particular setting, you really do need to, again, talk to your tax professional and talk about what's going on and what exactly is my eligibility in this and what can I do. A lot of times people that are, naturally already doing real estate, maybe they even already have a real estate agent license. And I should clarify that you don't necessarily have to have agency license to get this, but sometimes people do have it and sometimes feel they even want it just because, right? And so when you're already naturally in that realm, that extra step forward to participate in real estate where there's rental activities going on, it would be something that you would want to consider just both as an investment strategy for yourself and the ability to grow your cash, but also then an opportunity for you to save along the way. For the passive investor side, I think a great position also because you're getting that growth of money in and above the stock brokerage investment strategy, and being able to kind of balance that fluctuation or volatility that the market brings, and yet you and have some appreciated value in it, right? So you're growing your assets while you're holding it with little activity, with little risk. But we also are seeing that the realization of the tax benefits are kind of this waiting period. And so some people are okay with that, and I think that's great. And other people want to realize the benefits now. And so, I believe that there's advantageous, uh, you know, steps you can take in both directions. And for those that are real interested in that real estate activity and being materially participated, should consider how to get there, and what qualifications you need, and kind of checking off the list, before you actually make that election, and take the leap and make sure that you're able to qualify. And then once you get there, obviously, then you'll realize even more on a personal level what that means to you on your tax savings.